Well, it's coming up for mid-morning as we do this interview here in South Africa. But Anthony Ginsberg, who's the founder and MD of GinsGlobal Index Funds, is in Los Angeles. So he's just about ready to go to bed. Anthony, brilliant to be talking with you again. And I think there are a lot of good reasons why we should be talking right now. But I'm going to start off with our last interview, which was in November 2022. And the reason I want to start off there is it is a warning that you should never, ever, ever believe the stuff that you see on social media. On the screen right now, I have, for those who are listening to this on a podcast, you obviously won't be able to see, but it is a comment that was taken underneath the interview that Anthony and I did on the 22nd of November, 2022. He said, quote, "Tech wreck drove prices too low, smart money buying, big rebound in 2023. That's what Ginsberg said. Some really smart fellow, called Matthew Mann, says, this guy's talking his book, Cloudflare down 6.6% overnight, and down 70% over a year. However, is up 50% from its low. Have we reached the low? Ask me in a year's time." Well, Matthew Mann, I'm asking you, but what the hell do you know that puts you in a position to actually criticize a man like Ginsberg? Because, Anthony, you were spectacularly right. Before we go there, have a look at Cloudflare. That's when our Matthew Mann said, hey, we'll talk to him in a year's time. It was $40. It's now more than doubled. And have a look at Nvidia. That was back at that point about $100 a share. It's now well over $700. So I just wanted to show those couple of insights, just so we can put this into perspective, Anthony, because my word, you have been on the money as far as that call was in November 2022. I hope that there's been massive money flowing into GinsGlobal Index Funds, because I know you've been focusing on that.
Well, thank you, Alec, for having me. It's great to reconnect. As you know, we do broad indexed investing here across ETFs and index funds. Of course, we have this tech megatrend, which we can delve into, about AI and cloud and all these converging megatrends, which are very, very exciting. But we're actually a little more cautious than most. We don't tend to have products that are massively overweight in just 4 or 5 stocks. So we're very much in the passive realm. And as you know, there's been a huge tidal wave, Alec, over the last decade, really a new world order where actually a majority of money in the US in mutual fund land here, ETF land, goes into passive indexing. And that means they can buy tech themes, but it's generally a lot broader than just piggybacking on 4 or 5 very narrow stocks. So even the NASDAQ, incidentally, we see it as a very concentrated index. And our Megatrend ETF, for instance, equally weights 120 holdings, because we don't want to be massively overweight in just, the Magnificent Seven, for example, because actually the Magnificent Seven haven't all been magnificent this year. For instance, you've had Tesla come down, you've had Apple being flat as a pancake. So it's very hard to time these, but ultimately there is a huge trend going on here, certainly in the US, with not just AI, but how the convergence across social media, cybersecurity, cloud, AI, even electric vehicles, Alec, how it all interplays. And you can't time one sub-theme versus another. We see a lot of engagement across the board. You even see a firm like Microsoft buying a massive gaming company last year. It was the largest tech deal. They bought Activision, which many of our kids will know, for $75 billion. That's all about social media and bringing gaming into the mobile phone space. So, yeah, there's a lot of overlap. And I have to say that having come out of South Africa many years ago and having worked even at Barclays, people outside the US, I think, don't really understand how dynamic some of these companies are and just what sort of mountains of cash they're actually sitting on. This is not your father's 2000 bubble where PE ratios were over 100 times on the NASDAQ. And we were sitting with the NASDAQ at around 27, 28. The S&P is at just over 20 at the moment. during the bubble, the S&P was over 40, 45 at some point. So it's a very different story, Alec.
Anthony, let's just retrace a little bit. I had a fascinating discussion earlier this week with another man, another South African, who focuses all his attention on the international markets, has been doing that for the last 10 years. So he's avoided what Coronation are now calling the 10 lost years of investing in South Africa. And he is saying that it's always dangerous to say that this time it's different or things have changed. But there are compelling reasons, given the way that technology has gone, to be able to be forcing one to look at things very, very differently. What is your thesis on that side?
Well, our thesis is that generally more than half of the revenues of these tech companies are now increasingly global. So this is not just a US story. And when you look at something specifically like AI, yes, there may be some hype, and they're going to be certainly winners and losers in the AI space 5-10 years out. But who are the biggest buyers of AI at the moment? It tends to be the big cloud computing guys. You've got AWS, the big division of Amazon. I mean, Amazon's earning more money. Almost half their profits are coming not from my wife or myself buying up a lot of stuff in the driveway. It's actually coming through their cloud computing division. So cloud computing is also driving Microsoft's $3 trillion market cap now. Frankly, Microsoft Azure is one of the hottest cloud players out there. So they are huge buyers of Nvidia fast chips, because increasingly to actually run these algorithms and the large language LLM models like OpenAI, which is involved with ChatGPT, and even Bard from Google, you actually need to outsource this. The days of keeping the stuff in-house in your own servers is very, very much beyond us. So the thesis really is outsourcing.
Let's just stop there. Sorry, Anthony, stop there and just go back a little bit, because you're talking to guys who, some of them might be sitting on farms in the middle of the Karoo here in South Africa, and they are getting confused by all of this. Let's start at the very beginning. Cloud computing. That was one of the big themes. And then we can talk about what you've said, AI, artificial intelligence. So just tell us, like you're talking to, many years back when you had a client that you in South Africa and you were explaining things to them. What is cloud computing? Why is it so important? And then let's move into what is artificial intelligence and why is that just revolutionizing the investment markets?
Yes. Well, the days of keeping your IT in-house and trying to continually upgrade, it increasingly became more and more expensive, Alec. Over the last decade and a half, and more folks realize they just are not in the software business. They were hiring, I'm talking about banks, other regulated groups like insurers, they were hiring tons of these software engineers just to try and keep things together, sometimes with sticky tape, as it were. So increasingly they started outsourcing. And I'm a pretty simple guy. I've still got a family in the Karoo, of all places, in Dar. We have a farm out there still. So, this is not complicated stuff. Basically, it's an outsourcing story. If you want to actually have the fastest computing access, where you don't have to worry about upgrading to different software programs continually, you can go to a firm like Amazon or like Microsoft and get cutting-edge software. You rent it essentially by outsourcing it to their data centers, and you can actually up the dial or down scale the dial depending on how many hours or how much usage in terms of gigabytes you may need as a company. So it's a lot cheaper to rent during recessionary times. And obviously during COVID, there were certain spikes, there were certain decreases in usage, but it allowed people to dial up and dial down. The flexibility by paying a monthly subscription fee is a lot cheaper ultimately than having an in-house service center that you have to continually maintain with full-time staff. So that's really where it began, Alec. And then what's happened ultimately with AI now coming on board, you need massive computing power to run these algos and to actually run these large language models, the LLMs. So it's also outsourced. And more of the AI work that's being done by Fortune 500 groups, and over the next decade, it's expected most of it will be done through the cloud computing or third-party processors, basically through renting data servers and having it outside of your premises.
It's a wonderful explanation that you've given, Anthony, and really on a practical basis, pretty much every business in South Africa understands this. The conversation we're having now is on Riverside, which is a company based in Tel Aviv. And after we have finished this conversation, your video will be downloaded to their servers in Tel Aviv. My video will be downloaded to their servers in Tel Aviv. We will then access that onto our computers here in South Africa and use technology to put the whole thing together. It was just impossible a couple of years ago. So it gives you an understanding from a very practical, basic way, the way the world has changed and dramatically changed. But now the investment themes that you talk about, people are looking at this, and I've read a wonderful book called Engines That Move Markets, which had a look at, for the last, 20 massive innovations from the telegraph to railroads and so on. And it says it's so hard to pick the winners. So what you're doing, I presume, is saying these are the themes. So we know, for instance, there's railroads. People they're going to be big winners and big losers. Let's go across the board, almost like private equity. You invest in a number of companies, and that way you're going to have winners which are going to way outshoot whatever losers you might have in the portfolio. Is that the thinking behind
Well, that's the
GinsGlobal?
thesis. What we did, Alec, was to actually list an ETF on the London, German, and Swiss stock exchanges, which is called Tech Megatrend. And what we did is we selected 15 of the main leaders across each of these sub-themes. So robotics, AI, cybersecurity, cloud, gaming, social media, for instance, and even blockchain and electric vehicles. So it's a bit broader than just your generic IT sector. The old IT sectors, unfortunately, we all grew up with, have become a bit of a mess, because what's happened is the global classification system has thrown the likes of Facebook and Netflix into other categories, into other sectors like consumer, discretionary, and communication sectors, which were created. So IT today, if you just go to an old IT traditional fund, you're getting a very narrow group of semiconductor companies and maybe some software groups. You don't get the likes of the Netflixes or certain communications or social media players, such as a Facebook. So yes, what we try to do is pick out the 15 leaders. They generally are all profitable. These are generally large cap players, some mega caps, but it's equally weighted, and we rebalance it every 6 months so we can essentially take profits if it has run really hard, like an Nvidia. So we are not probably like some of the Cathy Woods out there that are going gangbusters with being very overweight or very narrowly concentrated with just 5 or 10 stocks. That's really interestingly enough, Alec, what we see in America. The pension funds, the 401k plans in this country do not want massive overweight or narrowness exposure to just 5 or 10 stocks comprising half their unit trust or half their mutual fund. They really want broad diversification. There's been I would say it's a new world order in the States where a lot of the big institutions have given up on the star fund managers over the years, and they do a blend of active and passive. There's room for everybody, but they generally are using some sort of broad indexing as a core to give exposure to these mega trends, and they're not betting the farm on one particular stock versus another. They tend to spread the risk.
So there are 15 stocks in a particular theme. So if you think robotics is going to be a big story into the future, and who doesn't, you have gone in at GinsGlobal and you've gone and looked at all the robotics companies around the world, and you've selected the biggest 15 or the 15 that you like?
It's actually done based on profitability and revenues. And actually, it's rules-based because it's a usage product, this particular one, the Tech Megatrend ETF on the LSE listing. It's about 5.5, 6 years old now. And what that actually does is it looks at generally the 15 leaders. It's mostly ranked by profitability, Alec. There are some revenue numbers as well and tradability factors. But then we've got 8 sub-themes. So all told, there are 120 holdings across electric vehicles, cloud, cybersecurity. And it's interesting how much overlap there could be. You will find that there's some M&A deals amongst these companies over the last few years as well. So the days of saying, well, I only want to do cybersecurity or I only want to buy AI, I think it misses the boat a bit because there's a lot of overlap. As I mentioned, Microsoft buying into this massive gaming player. It wasn't on people's horizons probably a few years ago. And then you see what's happened also with Facebook. Many of us wrote them off a couple of years ago when it come rollicking back. Zuckerberg just did a $50 billion buyback, as you know. The shares rocketed, although in one day, Nvidia now holds the record over $250 billion of market cap gains in a day. Facebook had $195 billion earlier this year in a single day. So hard to time these things. We just want to provide our institutional clients with exposure. We're the first to admit that trying to pick robotics this year versus AI the following year or cloud, it's very, very difficult because these things can be somewhat cyclical as well. I have to say there's a bit of a tailwind going on here in the States now because of the election this year. The Fed doesn't want to be overly partisan. They'll probably drop rates 3 times this year and begin well before the election, probably in the American summer, which is around the end of May, June. And that's a tailwind for growth stocks and tech stocks, Alec, as the rates start coming down. I have to just give you one aside since I'm living here in LA. The restaurants are chock-a-block. I mean, there's no talk of recession here. Most people expect some sort of a soft landing. Airlines are busy. It's very hard to see a slowing economy in this country. I mean, it may not be perfect by many means, increasingly also with the presidential election, but relative to the other bells of the ball in the UK and in Germany that are either in a recession or just coming out of a recession, including Japan, for instance, the US seems to be the prettiest bell at the ball currently.
Anthony, just to close off with, we have got model portfolios that we do have at BizNews, and there are 3 stocks in particular that I'd love to get your thoughts on. Hopefully you hold them. Nvidia is the biggest stock in our 10-year-old portfolio, which has done 20% compound a year for the last 10 years. It just shows where we were invested. Palantir is the biggest stock that we have now in our shift portfolio, which was launched at the very worst time, about the time we spoke in November 2022, when things were starting, well, before then actually, when things were starting to look really rough. And then another one that I'm quite interested to hear of is my favorite, Cloudflare. So Nvidia, Palantir, Cloudflare, if you know much about those, can you help us, please?
Yes, I'm happy to help you. We're actually positive on all 3. I have to say that Nvidia, obviously, it's the name of the game. It's become the 3rd largest stock by market cap in the US. Many people are worried that the PEs are very high. But interestingly enough, if you go back over the last almost decade, the average PE on Nvidia has always been around 35, 36, Alec. It's trading only at about a 32 PE. Just to give you a sense of the monumental change there, just in the last year, the 4th quarter of 2023 versus 2022, their profits went up tenfold from 1.2 billion to 12.5 billion quarter on quarter, if you go for the 4th quarter last year. It's unbelievable. I mean, their revenue grew about 5-fold. So actually, on a price to earnings basis, it's not excessive. We're very positive on cloud because cloud's actually growing at about a 20% annualized clip. Obviously, some of the big boys like Amazon and Google Cloud and the Microsoft Azure do have the lion's share, but there's a lot of overlap with cybersecurity and cloud. And the other 2 names you mentioned, Cloudflare and even Palantir, they have elements in both cloud and cyber. So we think it's a sweet spot. We expect actually more M&A activity across both spaces. Obviously, work from home continues. We have this issue here in New York and LA where many youngsters under a certain age don't want to come in 5 days a week. So cloud usage is still doing reasonably well. Even Zoom, for instance, had a very good recent quarterly report. So no, we're very positive that cloud's going to continue to grow. It's still early days, mind you, in cloud. The projections are that 50% of all IT spend will be in cloud linked to AI one way or another. This is enterprise spend. So basically half of all corporate IT spend will basically be touching cloud and AI by 2025. That's the projection.
Those are really positive insights. We launched the Shift portfolio in November 2021, which was the worst time, right at the top of the market. And we spoke last 2022. We're now talking February 2023. You were really on the money last time we spoke. Anthony, what's your view today?
My view is it's time in the market, not trying to time the market or not timing the market. So our view is the US in election years, Alec, tends to go up. It's not going to be a 24% S&P replication of last year, but it could hit double digits. I'm talking on the broader S&P market. We're not expecting the NASDAQ to roll it up another 45% in a year. But we remain positive. We actually think the tailwind of Fed rates coming down, but also the fact that the U.S. economy is healthy, unemployment's at a pretty much all-time low. We think that IT spending is actually going to improve. And actually, interesting quickly, on the digital revenues, this is digital advertising, the likes of Alphabet, which is Google, and others, Facebook, are seeing the benefits. And they've also been cutting their headcounts. I mean, Zuckerberg slashed 20% of his headcount over the last 2.5 years, and that's really helped his share price. I think a lot of the boys in Silicon Valley are very sensitive about cutting the fat, and it's easier in the US versus South Africa or in Europe to actually cut your headcount. So that's something to look out for too.
Anthony Ginsberg from GinsGlobal. You know where to invest your money if you believe in him, and clearly it's high diversification, but on the most focused areas of growth in the world. And this world is changing. We all know that. We look around and we can see it. He's with GinsGlobal, the founder and managing director, and I'm Alec Hogg from BizNews.com.